Welcome back to We Are Cosmic, the place where we break down what is really happening behind the financial system shifts that most people never see coming. Today's discussion is not about hype, and it's not about price predictions pulled out of thin air. It's about infrastructure, it's about settlement, and it's about the moment legacy banking publicly admits that blockchain is no longer optional. When the CEO of JP Morgan Chase says his bank moves $16 trillion in a single day, that statement alone should make anyone stop and think. But when he adds that this movement is already happening through blockchain-based systems and tokenization, that changes the entire conversation. This is not a crypto influencer speaking. This is the head of the largest bank in the United States confirming that tokenization, smart contracts, and on-chain settlement are now part of real-world banking operations. What we are witnessing is a structural transition. Banks are no longer debating whether blockchain works. They are asking how to implement it faster, cheaper, and at scale. Tokenization is no longer theory. It is being used for deposits, payments, compliance, and settlement, all while passing through anti-money laundering systems, sanctions checks, fraud monitoring, and regulatory filters. That matters because it removes the biggest argument banks used to have against blockchain adoption. The key point here is efficiency. Banks compete on speed, cost, and security. If one bank can settle transactions instantly, reduce costs by up to 90%, and operate 24 hours a day, every day of the year, other banks have no choice but to follow. And the problem is this: most banks do not have JP Morgan's budget, engineering talent, or development teams. They cannot build their own private blockchain infrastructure from scratch. That is where the conversation shifts from banks building technology to banks renting infrastructure. When a financial institution cannot build its own chain, its own token, or its own settlement system, it must rely on external providers that already have mature networks in place. This is where infrastructure companies like Ripple, Circle, and other blockchain-first firms enter the picture. These systems were designed over the last decade to solve exactly the problems banks are now facing. Now let's introduce the central question that frames everything going forward. If blockchain rails are used to move trillions of dollars every single day, what does that require from the settlement asset underneath? Settlement assets do not exist to be traded emotionally. They exist to move value, absorb liquidity, and finalize transactions instantly. That distinction matters. When people casually hear numbers like $16 trillion per day, they often fail to connect that scale to liquidity requirements. Money cannot move without capacity, it cannot flow without depth, and it cannot settle without assets that can handle velocity and turnover multiple times per day. This is where the discussion around XRP becomes relevant from an infrastructure point of view, not a speculative one. As we move deeper into this analysis, we will examine what it would mathematically require for a digital asset to support daily transaction volumes in the multi-trillion-dollar range. We will also explore why banks choosing tokenization and stablecoins create pressure on existing liquidity systems, not relief. And importantly, we will separate what is confirmed from what is still theoretical. There is also a secondary layer to this story that is now resurfacing after years of being dismissed. The idea that Ripple has always been positioning itself not just for payments, but for the derivatives and collateral settlement markets. With recent developments involving regulated exchanges, derivatives platforms, and institutional frameworks, some older theories are beginning to intersect with present-day facts. Finally, we will introduce a concept that ties everything together: liquidity compression. This is not hype language. It is mechanical. It is driven by regulated inflows, shrinking available supply, real settlement demand, and institutional custody. When these elements combine, price behavior stops moving gradually and begins to reprice structurally. Once banks publicly accept tokenization and blockchain as real, the next challenge is execution. JP Morgan can afford to build its own systems. Most banks cannot. This creates a structural gap across the global banking sector, and that gap explains why infrastructure providers become unavoidable. Traditional banks operate on legacy rails built decades ago. These systems were designed for limited operating hours, slow settlement cycles, and human reconciliation. Tokenization breaks those assumptions. A tokenized deposit is not just a digital balance. It is a programmable financial instrument that can move instantly, settle globally, and interact with smart contracts in real time. This requires always-on infrastructure, deep liquidity, and automated compliance. Banks quickly discover that building this internally is expensive, slow, and risky. Blockchain development is not the same as updating a database. It requires cryptography, distributed systems, security auditing, continuous uptime, and regulatory integration. That is why most banks reach a fork in the road. Either they invest billions to replicate what already exists, or they connect to infrastructure that has already been tested in live markets. This is where companies like Ripple become relevant. Ripple did not start as a speculative crypto project. It was designed as a payment and settlement network capable of operating under regulatory frameworks. Over time, it built payment corridors, liquidity tools, compliance features, and enterprise-grade integrations. This matters because banks do not need flexibility. They need reliability. When banks cannot issue their own tokens efficiently, they turn to stablecoins. Stablecoins allow banks to tokenize value while maintaining fiat parity. However, stablecoins still need a fast, neutral settlement rail underneath. A stablecoin alone does not solve cross-border settlement, intraday liquidity shortages, or FX inefficiencies. It still has to move across systems. This is where XRP enters the discussion at a structural level. XRP is not positioned as a store of value. It is positioned as a bridge asset. Bridge assets exist to move liquidity between endpoints quickly and without friction. That role becomes critical when transaction volumes scale into the trillions per day. To understand why price becomes a variable in this system, we need to talk about liquidity and turnover. XRP does not need to represent the full value being moved. It needs to turn over fast enough to facilitate that movement. Think of it as a liquidity engine rather than a vault. The same unit of XRP can be reused multiple times in a single day if settlement is fast enough. Now consider the supply dynamics. While the total circulating supply of XRP is often referenced publicly, that number is misleading. The usable liquid supply is much smaller. Coins in long-term wallets, escrow, or institutional custody are not available for daily settlement. The actual liquid supply is what sits on exchanges, with market makers and inside payment corridors. If only a few billion XRP are actively available for settlement, and that pool is being reused 3 to 5 times per day, the price per unit must rise to support higher transaction volumes. This is not speculation. It is arithmetic. Higher flow through constrained liquidity requires higher unit value. This is why comparisons to traditional market capitalization frameworks often fail. Market cap assumes static ownership. Settlement assets operate on velocity. When assets are locked into corridors, custody accounts, or institutional frameworks, the remaining supply becomes thin. Thin markets reprice quickly when demand increases. Another important point is competition. Banks are not competing with crypto, they are competing with other banks. Once one institution offers cheaper, faster, always-on payments, customer behavior changes. Customers follow value. Banks that cannot adopt new rails lose deposits, volume, and relevance. This is the same innovation cycle seen repeatedly in finance. Early resistance turns into forced adoption. Those who adapt survive. Those who do not disappear. Blockchain does not replace banks. It replaces inefficient processes inside banks. Payments are large, but they are not the largest market in global finance. The real scale exists in derivatives, collateral management, and balance sheet optimization. This is where the conversation around Ripple and XRP begins to shift from simple cross-border payments to something much more complex. The global derivatives market is often quoted in the hundreds of trillions or even quadrillions in notional value. While notional value does not represent actual money at risk, it does reflect the scale of contracts that require settlement, margining, collateral movement, and netting across institutions. These systems depend on speed, finality, and trust between counterparties. Today, derivatives settlement relies on layers of intermediaries. Clearinghouses, custodians, correspondent banks, and reconciliation systems all add cost and delay. Capital becomes trapped as margin because institutions cannot net positions efficiently in real time. This is not a small inefficiency. It costs banks billions in opportunity cost every year. This is why infrastructure organizations like ISDA matter. ISDA is not a retail brand. It is the rule book for derivatives markets. When a company engages with ISDA, it signals interest in how derivatives are structured, governed, and settled. Ripple's decision to join ISDA in 2023 was not random. It placed Ripple inside the conversation around derivative standardization and settlement frameworks. At the same time, we saw regulated platforms like Binomial emerge. These are not offshore exchanges. They operate under CFTC oversight and focus on compliance-first derivatives infrastructure. Ripple leading a funding round in such an entity is not about speculation. It is about positioning near regulated financial plumbing. This does not mean XRP is guaranteed to be used for derivative settlement. That conclusion would be premature. What it does mean is that the idea is no longer purely hypothetical. The pieces now exist within the same regulatory environment. That alone changes the probability discussion. The most interesting part of this evolution is collateral efficiency. In derivatives markets, assets are moved not to be spent, but to be pledged. Collateral must move quickly, remain liquid, and maintain trust. If a digital asset can function as neutral, instant collateral across jurisdictions, it becomes extremely valuable regardless of retail sentiment. XRP's design aligns with this type of usage. Fast settlement times reduce counterparty risk, predictable fees support cost modeling, finality allows firms to free capital sooner. None of this requires XRP to replace national currencies. It requires XRP to function as a liquidity shim between them. A key misunderstanding is that high price targets imply unrealistic market capitalization. In infrastructure context, price is not driven by ownership duration. It is driven by flow, demand, and constrained liquidity. If large volumes require access to a limited number of tokens within tight time windows, price adjusts to ration that access. Another factor is regulatory comfort. Institutions do not move first. They wait for clarity. Once regulation solidifies, adoption accelerates quickly. That pattern has repeated across every financial innovation, from electronic trading to real-time payments. What we are likely watching now is not a sudden revolution, but a slow alignment. Stablecoins gain regulatory clarity. Tokenized deposits become acceptable. Settlement rails modernize. Derivatives platforms go on-chain in controlled environments. Each step independently seems small. Together they redefine financial plumbing. It is important to stay grounded here. None of this guarantees outcomes. Infrastructure adoption is incremental. Timelines stretch longer than narratives suggest, but when infrastructure finally flips, it moves fast. There is little warning. The connection between Ripple, XRP, and the derivatives market. In simple terms, derivatives are financial contracts whose value comes from underlying assets like stocks, bonds, or currencies. Globally, derivatives represent trillions of dollars in financial activity. Ripple's involvement with derivatives is not about speculation. It's about positioning XRP as a potential settlement asset in a regulated financial system. Back in 2023, Ripple joined the International Swaps and Derivatives Association, ISDA. This is significant because ISDA sets standards and rules for derivatives markets worldwide. By joining, Ripple placed itself in a position to interact with one of the largest financial markets on Earth. The connection becomes even more interesting with developments like Binomial, a platform building a regulated derivatives exchange in the U.S. overseen by the CFTC. Ripple has been actively participating in funding rounds and collaborations with Binomial, demonstrating its engagement with the infrastructure that supports regulated derivatives trading. Why does this matter for XRP? If XRP is used in any part of derivatives settlement or liquidity management, it could become a core financial utility rather than just a speculative asset. Think of it this way. Banks and institutional investors need a stable, fast, and reliable settlement medium. XRP can act as a bridge between different currencies and financial instruments, making settlement smoother and faster. This is very different from most cryptocurrencies, which are primarily used for trading and speculation. XRP's adoption in institutional systems would be tied to real-world utility, and that changes how we understand its role in finance. Adding another layer, regulated stablecoins like RLUSD are being used to complement XRP in these systems. Banks prefer assets that are predictable, compliant, and capable of integrating into existing financial rules. When XRP is combined with regulated stablecoins and payment corridors, it creates a continuous, reliable flow of liquidity. This predictable usage helps XRP move beyond speculative cycles and positions it as a tool that can handle high-value transactions in regulated markets. There's also a concept called the XRP liquidity compression flywheel, which ties into this. Here's how it works. When ETFs and institutional investors buy XRP and hold it in regulated custody, the circulating supply on exchanges decreases. This compression makes each available XRP token more valuable when demand rises. Then, as banks and enterprises use XRP for real settlement flows, it reinforces demand even further. Add regulated stablecoins and enterprise-level identity protocols, and you get a self-reinforcing system that combines supply reduction with predictable usage. This isn't speculation, it's the structure of a network designed for efficiency. It's worth noting that while some of this may seem like a conspiracy theory to outsiders, all of the pieces we've discussed are real. Ripple is joining ISDA, participating in regulated derivatives platforms, and building relationships with institutional partners. These moves indicate a strategy where XRP could be positioned at the center of large-scale, regulated financial flows, including derivatives and cross-border payments. The difference here is thinking like a banker, not a trader. Banks focus on finality, liquidity, and compliance, not hype or short-term speculation. Now, let's take a closer look at the liquidity compression flywheel, one of the most important concepts for understanding XRP's potential in the real financial world. This idea explains how XRP could become a self-reinforcing system where reduced supply and increased usage combine to create structural support for the token. It's not speculation, it's a mechanical process based on how institutions adopt and hold XRP. The first stage of the flywheel starts with institutional inflows. Regulated ETFs and large investors are gradually buying XRP and holding it in long-term custody. These assets are not used for day-to-day trading. They are locked away as part of institutional portfolios. This reduces the amount of XRP available on exchanges, creating a smaller liquid supply. Less supply means that any increase in demand has a bigger impact on the price because fewer tokens are available for transactions or trading. Stage 2 involves exchange reserve compression. As ETFs and institutions accumulate XRP, market makers and exchange inventories shrink. Thinner exchange balances mean that price movements become more sensitive to demand. If demand rises even slightly, the price reacts more sharply because there is less XRP available to absorb trades. This stage makes the market more efficient, but it also makes XRP more reactive to real-world utility flows rather than speculative trading. Stage 3 introduces regulated payment corridors using stablecoins like RLUSD. Banks and enterprises prefer assets that are predictable and compliant with regulations. By integrating XRP with regulated stablecoins, predictable on-chain liquidity cycles are created. XRP is used to move money between stablecoins and fiat currencies, generating continuous demand for settlement purposes. This stage expands XRP's structural usage, turning it into a practical tool for large-scale transactions. Stage 4 involves enterprise-level identity verification using technologies like zero-knowledge, ZK protocols. These allow institutions to comply with regulations while verifying identity and access without exposing sensitive data. This enables banks and corporations to use XRP for high-value transactions securely and efficiently. The adoption of ZK infrastructure unlocks enterprise-level utility, expanding the network's real-world applications. Stage 5 is institutional custody, which finalizes the flywheel. When banks, asset managers, and treasurers hold XRP in regulated custody, the circulating float becomes fragmented and permanently reduced. More locked supply means that fewer XRP tokens are available for marginal buyers. As a result, even normal transactional demand can drive significant price adjustments. The combination of supply reduction, predictable usage, and enterprise-level adoption creates a continuous compression cycle. When all these stages come together, the flywheel spins in one direction only. As supply decreases and usage grows, XRP's value can reprice quickly and efficiently. This is different from typical crypto price movements, which are often driven by speculation or market sentiment. Instead, XRP's price would be influenced by real financial activity, structural demand, and the flow of capital through regulated and compliant channels. Additionally, XRP's integration with stablecoins and payment systems ensures that liquidity is not just compressed, but also recycled efficiently. Transactions occur multiple times per day, increasing the velocity of each token and enhancing its utility. This makes XRP more than a speculative asset. It becomes a core component of the financial infrastructure that supports real-world money movement. As we reach the final part of this series, let's look at the latest developments shaping XRP's role in the financial ecosystem and what this could mean going forward. One key factor is the growth of RLUSD, a regulated stablecoin that works alongside XRP. RLUSD's market cap has been steadily increasing, reflecting adoption in payment corridors and enterprise-level systems. When paired with XRP, stablecoins create predictable liquidity flows, making XRP a practical tool for real-world transactions rather than just a speculative token. Regulatory clarity has also been improving. Laws and frameworks like the Genius Act, passed in mid-2025, have provided guidance for dollar-denominated stablecoins and digital payments. This gives financial institutions confidence to adopt blockchain technology and integrate XRP into their systems. With clear regulations, banks can innovate without fear of non-compliance, which further strengthens XRP's position as a settlement asset. Regulatory clarity is essential because it allows XRP to operate in both domestic and international financial systems without legal uncertainty. Ripple's partnerships and collaborations are another critical factor. The company has been actively working with regulated platforms, including Bitnomial, which is building derivatives and futures markets for digital assets under CFTC oversight. Ripple has participated in funding rounds and has representation on boards, showing that it is deeply involved in building infrastructure for regulated financial products. This positions XRP at the center of high-value financial flows, including cross-border payments and potentially parts of derivatives markets. While this doesn't guarantee specific outcomes, it illustrates the scale and seriousness of Ripple's strategy. All of these elements tie back to the liquidity compression flywheel. Institutional custody, ETF accumulation, stablecoin integration, and enterprise adoption all work together to reduce XRP's available liquid supply while increasing its operational use. This creates a self-reinforcing cycle where structural demand continues to grow, independent of market speculation. As a result, XRP could become a core settlement tool in global finance, supporting high-volume, high-value transactions efficiently. Additionally, Ripple continues to expand its ecosystem through events like Swell, where they showcase tokenized assets, stablecoin innovations, cross-border payments, and DeFi applications. These initiatives highlight the practical applications of XRP and its associated technologies in real-world finance. Enterprises and banks can now see tangible examples of XRP in action, which helps accelerate adoption and integration. It's also worth noting that XRP's price potential is tied to utility and liquidity, not just speculative hype. When most XRP is locked in institutional corridors and used in regulated systems, a relatively small amount of liquid supply can support significant transaction volumes. This means that XRP's market dynamics are fundamentally different from typical cryptocurrencies. Its value comes from real-world financial activity, predictable flows, and adoption by regulated institutions. In conclusion, XRP's future is being shaped by multiple converging factors: stablecoin integration, institutional adoption, regulatory clarity, enterprise-level utility, and the liquidity compression flywheel. These elements suggest that XRP is positioned to become a critical part of the financial infrastructure, capable of supporting large-scale, compliant, and efficient transactions. While nothing in finance is guaranteed, understanding these mechanisms gives us insight into the potential trajectory of XRP beyond speculation, emphasizing practical utility and structural demand. By following these developments, anyone interested in the future of money can see how blockchain, tokenization, and digital assets like XRP are changing the financial landscape. XRP is not just another cryptocurrency, it is a potential foundation for modern, efficient, and regulated global finance.